Welcome back to the channel. My name is Stephen Nguyen. I'm a pharmacist and I own 52 units of real estate. So I wanted to take a second video on regards to the 8-unit apartment complex that I came across in Birmingham, Alabama. Check out my first video for more details. But for those who haven't seen the video yet, I basically sent out a direct mailing campaign back in March of 2021. And literally 3.5 years later, this owner reached out to me saying, "Hey, I'm now in position to want to sell. Are you interested in buying?" So I've been communicating with him via email predominantly. He has been pretty responsive to me, which is usually a good sign that he's motivated to sell. And basically what happened was he wants tax assessed price of 420K. So this is an 8-unit apartment complex, so a little bit over $50,000 a door. And he said he rents out each unit for about $525 per door. So roughly you're getting around 8,000 no, sorry, $4,000 a month in income. So this does meet the 1% rule, right? Barely, because you have 50K per door and you rent for $500 each. And he owns his property free and clear. And I was trying to pitch him creative financing because I know, given the numbers, it's not going to look good, right? So let me run the numbers real quick. So he says, I looked at his P&L, right, and his Schedule E, and he basically had about $44,000 in gross rents for a year, and take half that out for expenses. So he was being honest with his expenses, which is good. So 22,000 for expenses, and your net operating income is $22,000 per month, right? Or per year, excuse me. And if you take that divided by a 10 cap, and why I assume 10 cap is because interest rates are about 7.5%. So I want to give myself some cushion and give myself some margin. So, okay, if you do 22,000 divided by 10 cap, the valuation is about 220K, right? And that's about 200K less than what his tax assessed value is. And if you divide it by an 8 cap, it's going to be maybe about closer to $300,000 at maybe 260K-ish, give or take. So basically, those are the type of offers that would make sense for me right now. So knowing that, I kind of said, all right, thanks for the P&L and the Schedule E. I'm gonna send that to my lender. And but as I'm waiting for the lender, are you interested in doing seller financing since you own this property free and clear? And then I just said, ideally this is better in person to build trust. But I said, a lot of owners who own it free and clear, if they want to, defer capital or avoid long-term capital gains tax. And I actually calculated out his long-term capital gains tax rate. So, I think the first, I forgot, I want to say the first 50,000, it's 0%. And then from 50 to I want to say 250, it's 10%. And then whatever's above that, it's 20%. So it's kind of like a stepped up scale. So you can Google it. I forgot off the top of my head, but I calculated the math. And roughly, he was going to pay about $50,000 in capital gains tax to Uncle Sam if he sold the property. So I actually calculated for him and just said, hey, you're going to have to pay $50,000 in capital gains tax if you sell it outright. So I just said, are you interested in doing, and you still get monthly income? And I said, are you interested in doing something like this? And then he responds saying, no, I'm not really interested in becoming the bank on this deal. So what that tells me is that he doesn't have trust yet, and he wants to hear back from the lenders, right? Because I know already that the lenders are going to underwrite this. They're going to think it's going to be $300,000 at most, right? Given these interest rates. Because what happens is if your interest rate is 7.5%, they're going to underwrite a cap rate above 7.5%. So even if I give them an 8 cap, being generous, it's going to be close to $300,000 at most. So usually, if literally they want tax assessed price, that's a good deal. I bought my 26 unit tax assessed price. I bought my 20 unit below tax assessed price. And every time I bought at tax assessed price, it's a good deal. So he's being reasonable, right? That's what I mean by he's motivated. He wants to sell. So now that he turned down my creative financing option, I wanted to plant the seed in his mind, right? So now I'm going to send this to my underwriter, to my lender. So I have a couple of brokers that I work with. So I'm gonna send him the Schedule E. I still need a rent roll from this guy, but I'm assuming all 8 units are rented out, and it's about $525 each. And basically, they're gonna underwrite it and just say, oh, what's gonna happen is you have to hit a debt service coverage ratio of 1.25%, right? So let's just say that he wants 420. So you do 25% down. And what's that 25% down roughly going to be? It's going to be about $100,000. So let's just make the math really easy. 400,000 for the purchase price, $100,000 down. I have a $300,000 loan at 7.5% interest. So roughly, because my 20 unit has about a $300,000 loan at 6.5% interest, and I pay $2,600 a month, right? So, okay, let's just make it a little bit higher than that. So it's about, let's say $2,800 a month, right? So NOI wise, I'm making $22,000 a year. So let's just make it $24,000 a year for easy math. That's $2,000 a month in NOI, but my loan is 28. So I'm cash flow negative $800 a month. So the bank's not going to take this deal, right? So either I have two options at this point. Either I have to do a larger down payment. If I do a larger down payment, then my loan is less. If my loan is less, my monthly debt service is less. And remember, if my net operating income per month is $2,000, that has to be 25% higher than the monthly loan payment, right? So roughly, what is that? It's going to be around like maybe 1,600 is going to be my monthly loan payment. So I have to make a large enough down payment until my monthly loan is $1,600 a month, so that my $2,000 NOI qualifies, right? So I have to make a large down payment, whatever that looks like, right? I haven't calculated yet, right? And for me, I don't want to do a large down payment because I'd rather spend the money towards renovating the unit to see if I can raise it up to market rents, right? So that's one thing working against me. So what I'm going to do is, hey, I brought this deal to my underwriter, and this is how they evaluate the property. I'm going to assume 25% down, and the offer is probably going to be $300,000 max, 120K less than what he wants. And then I can say, hey, this is what I got pre-approved that, but if you're willing to seller finance the deal, I could give you the price that you want of 420K, right? And then see what he says. So I present him two offers once my underwriter gets back to me, right? And I know that's how they're going to underwrite the deal. So I'm going to engage a couple underwriters and see what happens, right? So, so that's what's nice about having multiple underwriters. But I already know what they're looking at. So I don't want to do a large down payment. So I'm going to either, instead of doing a larger down payment, I'd rather lower the purchase price to make sense for me, right? That's the two-way to make the property work. Either lower the purchase price or you increase your down payment, right? So if I had like 50-60% down payment, maybe it's worth it, but I like to leverage, especially when I'm buying, because I want to use the rest of the money to renovate the apartment complex. And that's what I would explain to the owner too. If he seller finance the deal is, hey, I'm putting low down, but think about it, I'm putting in $10,000 per door. That's $8,000 total to renovate the property to make it 2024 standard, right? And then peripherally, I was kind of scanning the rents to see what market rents was, and he is using a property management company. So I thought, oh, it's $500 a little bit too low. So I went on apartments.com and literally I typed in apartments in Birmingham, Alabama, and your A-class apartment complexes are renting for $1,000 to $1,500 a month, right? And this is your A-class, like brand new, nice amenities, pool, gym, built within the past like probably 5 years. But when I started looking at like more C-class apartment complexes that were renovated, the most I saw was around $700. So knowing that, the most I could do is raise it by $200, assuming the area isn't in a rough area. I haven't even engaged my property manager yet about the property. But if they say, oh, you know what, that's the max rent, then maybe the deal is not really worth it, right? Because I have no margin to increase the rent. If I have no margin to increase rent, I have no margin to increase NOI, no margin to increase the value. At that point, I would be buying this asset only for cash flow and for tax depreciation purposes, which I can't use yet because I'm not a real estate professional, right? So this is how I go through my deals and underwrite it, right? So it doesn't make sense right now, but so what I do is I always make an offer, right? So I'm gonna make two offers, one at traditional financing, which is probably gonna be about 260 to 300K offer price, versus his tax price seller finance. And I would create the terms in a sense that I would be able to cash flow this property, right? So, this is kind of my thought process going to the deal. But, if I find out it's a rough area, I don't want to waste my time and move on. Like, I never compromise location, right? And if I find out that there's no upside in rents, then maybe it's not worth it for me to buy, right? And what's kind of crazy, and I thought about it too, was like, I own a single family home in Huntsville, Alabama, which is an A-class A-class area, good school districts. And I could buy a brand new build, A-class, for about 260K to 300K. So let's just make it 260. And they rent for $2,000 each. So literally, I could buy a 260K unit, buy two of them. So what's that? 520. So it's $100,000 more. 520K versus 420K. So 520K for two brand new construction single family homes in A-class areas, or I could buy 8-unit apartment complex for 420K in maybe a C-class area. And the rents will be roughly the same, right? It's about 4,000 for the 8-unit, and for each of the single family homes, it's 2,000 each. So that's 4,000 total. So it's 4,000, 4,000. But the A-class, I have a better tenant. I have new construction, so it's going to appreciate a little better, and I have all the warranties on it, right? So like now I'm like thinking like what's on. So to me, if the market rent for the apartment has the ability to raise up, and I can raise up the NOI, and I can raise up the value, it's worth to do that multifamily. But if the multifamily is already maxed out, in this case, it might be better for me to go to the single family because it's easier to manage, no renovation, no headache, right? So this is how I'm thinking about the 8-unit versus maybe buying two new build constructions. Like, do I just want two new build constructions, no headache, or less headache, or do I want to do the 8-unit? You know, the demographic of tenants, it won't be as great, and you know, if there's no margin to increase the rents, then it may not be worth it. So this is what I'm gonna look at. So the next step I'm at is sending it to my lender, see what he thinks, and then I will submit my two offers, or if it, I'll reach out to my property manager, see what the rents are. He wouldn't give me pictures of the units. So I don't know what the condition is, but I'll assume that probably needs renovation to be on the safe side. So in any case, wanted to give an update on my 8-unit apartment complex in Alabama to show you my thought process on this. You know, I'm not really motivated to buy, but I want to kind of share my thought process analyzing these deals. If you're interested in buying multifamily, or if you're interested in getting wholesale this 8-unit apartment complex, if I can make it work, reach out to me, join the Multifamily Mentorship Program. Check out the link down below. Please like, comment, subscribe. Let me know if you have any questions. Hope to see you in the next one. Thank you.